Hi, everyone. So there's a lot of speculation at the moment that Spotify might undertake a stock split because it's currently trading at about $481 per share. Now, if you're scratching your head thinking, what is a stock split? Why do companies do them? And most importantly, what does it potentially mean to you? Then this video is going to help you. Today, I'm going to cover what is a stock split? Why do stock splits happen and what does it mean to you? I'm also going to look at a successful stock split using Apple as an example. Then we're going to look at what you should watch out for when it comes to stock splits. And finally, we're going to talk about something else, which is known as a reverse stock split and what that is. First up, what even is a stock split? So in the simplest terms, when a stock split takes place, one expensive stock splits and becomes two or more cheaper stocks. A stock split is where a company increases the size of their float. Now, you might ask, what is a float? So imagine a company has a jar filled with 10 shares. These are the total number of shares available for trading in the market. This is called a float. Now, let's say each share costs $100, but the company decides to do a stock split to make the shares more affordable and more easier to trade. After the stock split, the number of shares in the jar doubles to 20, but the total value of the jar hasn't changed. It's just split into smaller pieces. So now each share costs $50 instead of $100. So why do companies even do stock splits? Well, for a few reasons. One, to make shares more appealing to smaller investors who might see high prices as unaffordable. Two, to create a psychological sense of increased ownership among current shareholders. And also to enable investors to buy more shares without changing the stock's overall value. So let's look at a successful case study of a stock split using Apple. So Apple did a 7-to-1 stock split in late 2014. And basically, this split allowed the price per share to decrease from over $600 to around $90. This made the stock way more accessible to everyday investors and resulted in a surge in demand for the stock. And today, many years later, Apple's market capitalization is standing at over $3.4 trillion. What to watch out for when it comes to stock splits? A stock split doesn't actually change the company's value. It's like slicing the same pizza into more pieces. So don't let the new lower price per share fool you. Check the company's absolute fundamentals. Are they still making money? Are they still growing? Are they staying competitive? They are the things that matter. Beware of the hype. So splits can create short-term excitement, driving prices up temporarily. But what goes up often comes back down once the buzz fades. And then also, if the stock pays dividends, here's a heads up. After a split, you'll earn less per share. It's not a big deal if you're planning on holding onto your stock, but it's good to know what to expect. And then finally, a reverse stock split. So a reverse stock split is when a company combines its shares to reduce the total number available. Let's say you own 10 shares at $10 each, so your total investment is worth $100. If the company does a 5-to-1 reverse stock split, your 10 shares will turn into 2 shares. But now each share will be worth $50 instead of $10. Your total investment is still $100, so nothing changes in the value, just the number of shares and their price. But why don't investors like reverse splits? Well, basically, it often signals the company is struggling and trying to make the stock price look better without fixing the actual business. Plus, with fewer shares available, it can become harder to buy and sell the stock. That's why reverse splits usually make investors quite uneasy. And that's it for stock splits. If you enjoyed this video, please do like and subscribe for more financial and investing concepts explained in plain English.